When we ask whether a war could trigger a global recession, the first place to look is not policy responses or long-term adjustments, but the initial shock itself. Because recessions rarely begin gradually. They often begin with a disruption that changes expectations almost overnight. And in a globalized economy, that disruption tends to travel quickly, especially when it touches energy, trade routes, and financial markets at the same time. Let's start with energy. Energy is not just another commodity. It is the system that powers everything else. When conflict erupts in or around major energy-producing regions, markets immediately begin to price in risk. And that pricing is not purely about current supply. It is about future uncertainty. Will supply be disrupted? Will shipping routes be blocked? Will production decline? These questions matter more than the actual barrels of oil being produced on any given day. So this is where psychology plays a critical role. Markets are forward-looking and they are highly sensitive to fear. Even the possibility of disruption can trigger price spikes. We've seen this pattern repeatedly. Tensions rise, traders anticipate worst-case scenarios, and prices move before any physical shortage occurs. In that sense, war doesn't just affect supply, it affects perception. And in global markets, perception is often just as powerful as reality. Now, when energy prices rise sharply, the effects cascade through the entire economy. Transportation costs increase. Manufacturing becomes more expensive. Food prices rise because agriculture is energy intensive. Consumers feel the pressure almost immediately. And when consumers feel that pressure, they change their behavior. They spend less, they delay purchases, they become more cautious. This is where a potential recession begins to take shape, not as a single event, but as a series of interconnected reactions. Higher costs lead to lower consumption. Lower consumption leads to reduced business revenue. Reduced revenue leads to cost cutting, often in the form of reduced hiring or investment. And once that cycle begins, it can reinforce itself. At the same time, trade routes come under pressure. War can disrupt key shipping lanes, especially those that pass near conflict zones or politically sensitive regions. When that happens, companies are forced to reroute shipments. Rerouting is not just a logistical inconvenience. It adds time, cost, and uncertainty to the system. And in a world that depends on just-in-time delivery, even small delays can have outsized effects. Think about how tightly integrated global trade has become. A single product might rely on components sourced from multiple continents, assembled in another, and distributed globally. When even one link in that chain is disrupted, the entire system feels the impact. Production slows, inventory shortages emerge, and businesses are forced to adapt in real time. This creates a second-order effect, uncertainty. Uncertainty is one of the most powerful forces in economics because it affects decision-making at every level. When companies don't know what to expect, they delay investment. They hold on to capital. They become more conservative. This is not irrational. It is a rational response to an unpredictable environment. But when many companies behave this way at once, the result is a slowdown in economic activity. And here's the key point. Recessions are often less about what is happening and more about how people and institutions respond to what is happening. War amplifies uncertainty, and uncertainty changes behavior. Now let's turn to financial markets. When war breaks out, we often see an immediate reaction, a flight to safety. Investors move capital into assets perceived as stable, government bonds, gold, certain currencies. At the same time, riskier assets, equities, emerging markets, corporate debt tend to come under pressure. This reallocation of capital has real economic consequences. Stock market declines can reduce wealth, which in turn affects consumer spending. Rising risk premiums can make borrowing more expensive for companies, and tighter financial conditions can slow down growth across the board. In some cases, this financial tightening happens rapidly, almost like a reflex. In others, it unfolds more gradually, but the direction is the same. Capital becomes more cautious, more selective, and more expensive. So, when we put all of this together, energy shocks, trade disruptions, and financial volatility, we begin to see a pattern. War introduces multiple sources of pressure at the same time, and those pressures interact with each other in ways that can amplify their effects. But it's important to be clear, not every war leads to a global recession. The outcome depends on scale, duration, and geography. A localized conflict with limited economic impact may cause short-term volatility, but not a global downturn. However, when a war involves major economic powers, key energy suppliers, or critical trade routes, the risk increases significantly. Because in those cases, the shock is not contained. It spreads. And that brings us to a broader, more philosophical point. The global economy is built on a delicate balance between efficiency and resilience. For decades, we leaned heavily toward efficiency, just-in-time production, tightly integrated supply chains, optimized costs. It created enormous growth and prosperity, but it also reduced buffers. War exposes that trade-off. It shows us what happens when a system optimized for stability encounters instability, and it forces us to confront a difficult reality that the very systems that drive growth can also transmit shocks. So the question is not just whether this war will cause a global recession. The question is whether our global system has enough resilience to absorb the shock, or whether the shock will force a recalibration that we are not yet prepared for. And the answer to that question will not be determined by markets alone. It will be determined by how we respond collectively to uncertainty, disruption, and risk. Because in a world this interconnected, stability is no longer something we can assume. It is something we have to actively build and constantly defend. If the first shock comes from energy and markets reacting to war, the second layer is how policymakers respond to that shock. And here, central banks sit at the center of the story, because in moments of crisis, they are often forced to make one of the most difficult trade-offs in economics, controlling inflation without collapsing growth. War tends to push inflation higher, especially through energy and food prices. These are not small components of the economy. They are foundational. When oil prices rise, transportation becomes more expensive. When fuel becomes more expensive, everything that depends on transportation, from manufacturing to agriculture, also becomes more expensive. At the same time, if key agricultural regions are affected by conflict, food prices can rise sharply as supply tightens. So central banks face a dilemma. If they do nothing, inflation can spiral, eroding purchasing power and destabilizing economies. But if they act too aggressively, if they raise interest rates too quickly, they risk slowing the economy to the point of recession. This is where monetary policy becomes less of a technical tool and more of a balancing act under pressure. Interest rates are one of the primary tools central banks use to control inflation. When rates rise, borrowing becomes more expensive. That affects everything: mortgages, business loans, credit cards, investment financing. In theory, this reduces demand, cools the economy, and brings inflation under control. But in practice, the effects are not evenly distributed. Businesses that rely on borrowing to expand may delay or cancel investments. Consumers may postpone large purchases, especially those that require financing. Housing markets can slow down significantly because they are highly sensitive to interest rates. And as borrowing slows, so does economic activity. Now, in a normal environment, this is manageable. Central banks raise rates gradually, monitor inflation, and adjust as needed. But war introduces a level of uncertainty that complicates this process significantly. Because inflation driven by war is not purely demand-driven, it is supply-driven, and that matters. If inflation is caused by too much demand in the economy, raising interest rates can help bring it down. But if inflation is caused by supply shocks like disrupted energy supplies or reduced agricultural output, then higher interest rates don't fix the root problem. They can even make it worse by slowing down the economy without resolving the underlying constraints. So central banks are effectively trying to use a demand-side tool to address a supply-side problem. And that creates a structural tension in monetary policy. But beyond the technical challenge, there is also a psychological dimension. Central banks are not just managing numbers, they are managing expectations. Their decisions signal confidence or concern. When they raise interest rates aggressively, it can signal that inflation is a serious threat. When they act more cautiously, it can signal that they are worried about economic slowdown. Markets pay close attention to these signals. Businesses adjust their plans. Investors reposition their portfolios. Consumers react to changes in confidence. In this way, central bank decisions become part of the broader psychological environment that shapes economic behavior. And in times of war, that environment becomes more fragile because confidence is one of the most important, yet least visible components of economic stability. When people believe that the system is stable, they act in ways that reinforce that stability. They invest, they spend, they take calculated risks. But when confidence begins to erode, behavior changes quickly. People become more cautious. Companies hold back, markets become more volatile, and those changes, once they start, can reinforce themselves in a feedback loop. This is where the risk of recession increases, not just because of the policies themselves, but because of how those policies interact with perception. Central banks are aware of this dynamic, which is why their decisions in times of war are often carefully calibrated. But even with the best intentions, they are operating in an environment that is inherently unstable. They are reacting to shocks they did not create while trying to maintain a level of control over forces that are partially beyond their influence. And that is the reality of economic governance in a globalized, conflict-prone world. There is also a geopolitical layer to consider. Interest rate decisions do not occur in isolation. They have global spillover effects. When a major economy raises rates, capital tends to flow toward that economy because investors seek higher returns. This can strengthen that country's currency while putting pressure on others. For emerging markets, this can be particularly challenging. Higher interest rates in advanced economies can lead to capital outflows, currency depreciation, and tighter financial conditions. If these economies are already dealing with the indirect effects of war, higher import costs, trade disruptions, inflationary pressures, they may find themselves under even greater strain. So, what starts as a domestic policy decision can quickly become a global force. And this brings us back to a broader point. In times of war, the line between domestic policy and global impact becomes increasingly blurred. Central banks are no longer just managing their own economies. They are navigating a global system that is under stress. But perhaps the most important insight here is this. Central banks are not omnipotent. They are powerful, but they are not all powerful. They can influence the direction of the economy, but they cannot fully control it, especially in the face of large-scale geopolitical shocks. And that is what makes this moment so important. Because when monetary policy meets geopolitical risk, the outcome is uncertain. It depends not just on data, but on judgment, not just on models, but on timing, not just on economics, but on leadership. So when we ask whether this war will cause a global recession, we are really asking a deeper question. Can policymakers manage the trade-offs between inflation and growth in an environment defined by uncertainty? And the honest answer is they will try, but the system they are trying to stabilize is already under strain. And that is what makes the path forward so difficult and so consequential. If monetary policy represents how governments respond to the economic shock of war, then the business response tells us something just as important, how the private sector adapts when certainty disappears. And because companies are in many ways the first to feel the shift in risk, and their reactions, delayed investments, cautious hiring, disrupted supply chains can quietly transform a slowdown into something much more systemic. Uncertainty is the central force here. Not fear in the abstract, but uncertainty in the practical sense, not knowing what comes next. Businesses operate on forecasts. They plan based on assumptions about demand, cost, supply, and regulation. War destabilizes those assumptions almost immediately. It changes input prices, disrupts logistics, and introduces geopolitical risks that are difficult to model or even anticipate. So what happens when the future becomes harder to predict? Companies pause. They delay capital expenditures. They hold back on expanding production capacity. They postpone entering new markets. These are rational decisions. When the environment is unstable, caution becomes a form of risk management. But when this behavior is replicated across thousands of firms simultaneously, the cumulative effect is a slowdown in economic activity. This is how uncertainty translates into macroeconomic impact. Now consider supply chains. Over the past few decades, global supply chains have been optimized for efficiency. The guiding principle was simple: minimize costs, maximize speed, and rely on global networks to deliver just what is needed when it is needed. This model worked exceptionally well under stable conditions, but it also created a system with very little redundancy. War disrupts that system in a fundamental way. When a key supplier is located in or near a conflict zone, companies must quickly reassess their exposure, right? Do they continue sourcing from that region? Do they find alternative suppliers, often at higher cost or lower efficiency? Do they redesign their entire production process to reduce dependency? These are not small adjustments. They are complex, costly, and time-consuming. And while companies work through these decisions, production slows. Orders are delayed, inventories fluctuate. The system becomes less predictable, and predictability is the foundation of modern supply chains. When that predictability breaks down, it doesn't just affect individual companies, it affects entire networks. A delay in one component can halt production elsewhere. A shortage in one input can ripple across multiple industries. And because these systems are so interconnected, the effects can propagate quickly and widely. This is where we begin to see the difference between a localized disruption and a systemic slowdown. A localized disruption affects a specific region or industry. A systemic slowdown, on the other hand, emerges when uncertainty spreads across the entire system, influencing behavior at scale. War has the potential to trigger both, especially when it involves major economic regions or critical supply nodes. But there is also a deeper psychological shift happening within the business community. In times of stability, companies operate with a forward-looking mindset. They invest in growth, take calculated risks, and compete for market share. In times of uncertainty, that mindset shifts toward preservation. The focus becomes not how to grow, but how to endure. This shift is subtle but powerful. When preservation becomes the priority, innovation often slows. Investment in new technologies may be delayed. Hiring may be reduced. Strategic initiatives may be put on hold. And while each of these decisions may be individually justified, their aggregate effect is a reduction in economic dynamism. That matters because growth is not just about output, it is about momentum. Economies grow not only when they expand, but when they maintain a forward trajectory. When that momentum slows, it becomes harder to restart. And this is one of the most important risks associated with prolonged uncertainty. It doesn't just slow the economy, it changes its trajectory. There is also a spatial dimension to this shift. Companies begin to rethink where they operate and why. Regions that were once considered stable may be reassessed. Supply chains may be shortened. Production may be brought closer to home, or at least closer to politically aligned partners. This process, often referred to as de-risking, is not about abandoning globalization entirely, but about recalibrating exposure to risk. But here's the trade-off. Resilience often comes at the cost of efficiency. Diversifying suppliers, holding more inventory, and building redundant systems all increase costs. And in a competitive global economy, higher costs can translate into lower margins, higher prices, or both. So companies are forced to balance two competing priorities, resilience and efficiency. That balance is not easy to strike, because if you optimize too much for efficiency, you become vulnerable to shocks. But if you optimize too much for resilience, you may lose competitiveness. And in a global market, competitiveness is essential for survival. So businesses are navigating a narrow path, trying to remain efficient enough to compete while becoming resilient enough to withstand disruption. And all of this is happening under conditions of heightened uncertainty. Which brings us back to the broader question, how does this contribute to the risk of a global recession? The answer lies in scale and synchronization. If uncertainty is localized, the impact is limited. But if uncertainty spreads across multiple regions and sectors at the same time, the slowdown becomes synchronized. Investment declines across industries. Supply chains adjust simultaneously. Consumer confidence weakens in multiple markets. And when these forces align, the risk of a broader economic contraction increases significantly. So the key insight here is this: recessions are not always triggered by a single shock. They are often the result of many small decisions made under uncertainty, all pointing in the same direction. And war accelerates that process. It introduces uncertainty at multiple levels, geopolitical, economic, operational, and forces businesses to react in real time. Those reactions, while rational on an individual level, can collectively produce a much larger macroeconomic outcome. So when we look at supply chains and business behavior, we are not just seeing adaptation. We are seeing transformation, a shift from efficiency to resilience, from expansion to caution, from certainty to contingency. And that shift, if it becomes widespread, has the potential to reshape the global economy in profound ways. Because in the end, the question is not just how businesses respond to uncertainty, it's how much uncertainty the system itself can absorb before it begins to contract. And that is where the line between slowdown and recession begins to blur. When we step back and look at the bigger picture, one of the most important questions we can ask is this: does this war lead to a localized economic shock, or does it trigger something broader, a synchronized global downturn? Because not all conflicts carry the same economic weight. Some remain contained. Others ripple outward, shaping the global economy in ways that extend far beyond the battlefield. The distinction comes down to scale, geography, and connectivity. If a conflict is localized, the economic impact tends to be uneven and region-specific. Markets may react, prices may fluctuate, and certain industries may feel pressure, but the global system can often absorb the shock. Trade reroutes, supply chains adjust, and the broader economy continues to function. But when a war involves major economic powers, critical energy producers, or key transit routes, the situation changes dramatically. Because at that point, the disruption is not isolated, it is systemic. And that's when the risk of global contagion begins to rise. Let's think about what we mean by contagion in an economic sense. It's not just about one country being affected and then another. It's about the transmission of stress through interconnected systems, financial markets, trade networks, supply chains, and investor sentiment. So when one part of the system comes under pressure, that pressure can spread, sometimes quickly, sometimes gradually, but almost always in a way that amplifies the initial shock. Now, why does this happen? Because the global economy today is deeply interconnected. Capital flows freely across borders. Trade networks span continents. Financial markets are linked in real time. This interconnectedness creates enormous benefits in times of stability. But in times of crisis, it creates pathways for disruption to travel. So if a major economy is directly involved in a conflict, or if a conflict disrupts key global systems like energy markets or shipping routes, the effects are rarely contained. They spread through multiple channels at once. Consider financial markets. Investors respond quickly to geopolitical risk. If a conflict escalates, we often see a shift towards safer assets, a flight to quality. Capital moves into government bonds, gold, or stable currencies. At the same time, equities, especially in risk-sensitive sectors, may decline. This movement of capital is not random. It is a coordinated response to perceived risk, but it has consequences. When capital leaves certain markets, it can lead to tighter financial conditions in those regions. That makes borrowing more expensive. It reduces liquidity, and it can slow down economic activity. Now imagine this happening across multiple economies at the same time. So that is the beginning of global contagion. But financial markets are only one part of the equation. Trade is another. If a war disrupts a major trading hub or a key manufacturing region, the effects ripple outward. Countries that rely on exports from that region may face shortages. Industries that depend on imported components may slow down. And as production adjusts, global trade volumes can decline. This is where the psychological dimension becomes especially important. In times of uncertainty, businesses and governments don't just react to what is happening. They react to what they think might happen. Expectations become a powerful driver of behavior. If companies expect further disruptions, they may reduce investment. If governments anticipate prolonged instability, they may adjust policies. And if investors expect volatility, they may pull back from risk. These expectations can become self-reinforcing. A slowdown in one region leads to cautious behavior elsewhere. That caution leads to further slowdown. And over time, what began as a localized disruption can evolve into a synchronized global deceleration. But here's the critical point. Not every shock leads to a global recession. The difference lies in how the system absorbs and responds to the shock. If countries are able to adapt, if they diversify supply chains, stabilize financial markets, and maintain confidence, then the impact may remain contained. Growth may slow, but a recession can be avoided. However, if multiple stress points occur simultaneously, if energy prices rise, financial conditions tighten, supply chains are disrupted, and confidence declines, then the system can tip. And once it tips, the effects can reinforce each other. This is what economists sometimes refer to as a negative feedback loop. Lower growth leads to lower investment. Lower investment leads to lower demand. Lower demand leads to further declines in production. And the cycle continues. Breaking out of that cycle requires intervention, either through policy, market adjustment, or a restoration of confidence. But timing is everything. If responses come too late, the downturn can deepen. If they come too early or too aggressively, they can create new imbalances. So policymakers are often navigating a very narrow path, trying to stabilize the system without introducing new risks. And in the background of all of this is geopolitics. Because wars don't just affect economies, they reshape relationships between countries. Alliances are tested, trade patterns shift, strategic priorities evolve. And over time, these changes can alter the structure of the global economy itself. So, when we ask whether this war will cause a global recession, we are really asking a layered question. Is the shock large enough to disrupt key systems? Is the system interconnected enough for that shock to spread? And is the response strong enough to contain it? The answer is not predetermined. It depends on a combination of economic fundamentals, policy responses, and perhaps most importantly, human behavior. Because in the end, recessions are not just about numbers. They are about confidence. And confidence is shaped by perception, by leadership, and by the ability of systems to adapt under pressure. So the real question is not just whether this war will trigger a global recession. It is whether our global system can absorb shocks of this magnitude without losing its balance. Because in a world as interconnected as ours, resilience is no longer just an economic concept. It is the difference between stability and collapse,